And a little less than an hour to go until those closing bells. Mandy joining us right now here on Bloomberg Television. She's head of equity derivative strategy over at Credit Suisse. And Mandy, I mean, look, the Fed started their meeting earlier today. We know we're going to get probably 75 basis points, maybe a full basis point, depending on, the fever dreams of some folks in the market here. How do you prepare for this, though? I mean, specifically, as you position in derivatives and options market, is there more that can be done now based on what we know?
Yes, I would say in terms of where market pricing is relative to our expectation, there's not a lot of divergence in the near term. Where we really diverge with market pricing is our outlook for next year. So yes, a lot of hikes are going to come in the next 2 to 3 meetings. But what really stands out to me is that the market is still pricing for rate cuts next year, about 30 basis points of cuts. And that hasn't changed since Jackson Hole, even though the Fed has come out more hawkish, even though we've priced in more rate hikes in the near term. That expectation of a dovish pivot at some point in the future, that stands out, and that to me, seems pretty incredible.
And Powell has thrown cold water on that idea so far, and that would be a pretty remarkable thing if they hiked rates into this year and then turned around next year and cut rates. I mean, what message does that send?
A mistake.
I think that the market is still operating under kind of the old Fed paradigm, where the Fed would turn more dovish when labor market data starts to weaken, when economic growth data really start to weaken materially. I think we're in a new paradigm where the Fed actually wants to see weaker demand side data, right? Whether that's labor market, whether that's GDP, in order to cool down inflation, because inflation is running so far above target. And I think that just means further weakness for equities, particularly some of these cyclical sectors.
If there's weakness ahead, what is the appetite like for protection right now?
So the interesting thing is that there's a bit of a divergence, I would say, at the index level versus at the single stock level, right? So one of the themes that we've been kind of highlighting all year is that even though we've had a very pronounced pullback in the market, even though FX rates, macro volatility, all very, very elevated, if you look at index vol, for example, the VIX, that's actually been very muted all year. And that's really because at the index level, we're really not seeing that appetite or that demand for protection, primarily because a lot of investors have already de-risked. They've reduced their equity allocation, they've shifted to cash. Now, if you look at the single stock level, that's where we're kind of starting to see a little bit more conservative positioning, people starting to take risk off the table a little bit at the single stock level going into year end. So one of the divergences we're highlighting is that volatility at the single stock level is actually very, very elevated, particularly compared to index, as well as compared to where they typically trade. And that's just a function of, the big moves that we've seen on earnings, right? FedEx, we can name, a bunch, as well as the earnings outlook, which you guys have, highlighted quite a bit going into year end.
Let's talk about some of that volatility. I keep hearing that the long-term average for the VIX is actually in the high teens. So 26, 27 is elevated, but it doesn't feel like the 30, the 40 handle that we typically get. What does the 26, 27 mean to you? Yeah, so the average VIX for this year, it's around 25. Yes, it is above long-term average, but then when you look at, for example, rates vol and FX vol, credit vol, commodity volatility, that's multiple standard deviations above average, like that, the VIX in the 20s is still considered low. And you compare it to kind of the 20% pullback in the market that we've seen. But kind of to bring back that divergence we're talking about with single stock volatility, single stock vol for most of this year has been higher than what we saw in February of 2018 when VIX shot up to 40. So that's, I think, that's the story that a lot of people miss by just looking at the VIX index.
Let's look at that story more broadly. What does it mean that people are doing? Yeah. What does it mean that hedge funds, that allocators are currently doing this scenario? They just decide, are they buying S&P and not finding that protection? Are they wanting to go on in individual names but protect themselves from a broader index move? What are they doing?
So the wanting to protect against a broader index move, that is not there. And I think part of the reason that is not there is because we actually haven't seen a hugely correlated move lower this year. We've seen actually quite a bit of dispersion, right? Like, for example, like energy and utilities are actually still up on the year, even though tech and discretionary are down, 20, 30%. What we're seeing in the single stock level, when I talk about people starting to position more conservatively, we're seeing investors take advantage of the high levels of single stock vol by overwriting, so selling calls against the positions they still currently own, basically saying there's a limited upside from here. Let me collect my premium, collect that that rich yield that's being offered in the single stock vol market.
Talk to me about the VIX and whether we're paying a little bit too much attention to it. I keep hearing people say they want to see it get to 30 or 40 before they get the real sign of capitulation. But is the signal that we get out of the VIX, at least that we used to get out of it years ago, is that still reliable today?
So again, this is a very common question we're going to get. When are we going to get that big VIX explosion? Right? When is VIX going to really start to wake up in this market environment? And I'll just highlight a few things. Right? We're seeing changes not only to the demand for volatility, demand for option, but also the supply. And another thing to highlight is we typically see the big VIX explosions when there's a lot of leverage in the system, and we're just not seeing that. Right? So coming out of 2020, a lot of the very leveraged funds, leveraged vol funds, right. They're not as active. A lot of the products out there that's super leveraged are not there anymore. So I don't think we're going to see.
Are people actually actively selling vol right now?
As yield enhancement, that is still very popular trade, and that even though Fed's taking rates up to 4% potentially, right, in terms of terminal rate, in the longer term history, that's still not enough yield for a lot of people's portfolios. So they're still looking to supplement that.
Cross asset, within your world of equities, what are you asking the fixed income guys? What are they asking you?
So I would say, what we're looking at in the fixed income world is just expectations for inflation. And what really stood out to me is in the fixed income world, inflation expectations, if you look at break-evens, have really fallen a lot, right? So I think at least there, the Fed is still being credible with its inflation, with its inflation objective. And to me, that's just going to mean, further pain for equities, because in order to bring inflation back down to target, I think we're going to see a lot more hits to demand.